Most people assume housing prices are high because of supply shortages or investor speculation. That explanation feels intuitive. Fewer homes, more buyers, prices go up. But beneath that surface logic sits a structural system that operates independently of supply and demand in the way we typically understand it. The question isn't just why homes are expensive. It's why the price-to-income ratio has diverged so dramatically over the past 3 decades, and why that divergence appears to be a feature of the system rather than a temporary distortion. The common belief. The dominant narrative around housing affordability goes something like this. Homes are expensive because there aren't enough of them. Zoning restrictions limit construction. NIMBYism blocks development. Investors buy up inventory. Foreign capital distorts local markets. If we could just build more housing, prices would stabilize and affordability would return. This belief is widespread because it's partially true. Supply constraints do exist. Construction has lagged population growth in many markets. Regulatory barriers do increase costs. The logic is clean. Scarcity drives price. Abundance lowers it. People also believe that housing prices reflect the value of the structure and land. A $500,000 home costs that much because of materials, labor, location, and market conditions. The price is a signal of worth. This framework makes sense if you view housing as a commodity subject to normal market forces, and in theory, it should be. But housing occupies a unique position in modern economies. It's simultaneously a consumer good, an investment vehicle, a store of wealth, and collateral for the financial system. That multiplicity creates incentives that don't align with affordability, and those incentives are embedded in policy, finance, and institutional behavior in ways that make price stability structurally difficult. How the system actually works. Housing prices aren't primarily determined by construction costs or even local supply and demand. They're determined by the amount of credit available to purchase them and the terms under which that credit is extended. When a buyer approaches a lender, the lender doesn't ask what the house is worth in materials and labor. They ask what the buyer can afford to pay monthly. That monthly payment is a function of income, interest rates, and loan duration. The purchase price is reverse engineered from that payment capacity. This means housing prices are effectively set by financing conditions, not intrinsic value. When interest rates are low, buyers can afford higher purchase prices for the same monthly payment. When rates rise, prices should theoretically fall to maintain payment affordability. But that adjustment is slow and uneven because sellers resist price cuts, and existing homeowners are insulated by fixed-rate mortgages. The financial system has an incentive to maximize loan volume, not affordability. Larger loans generate more interest income. Mortgage-backed securities depend on loan origination. The entire apparatus benefits from rising prices as long as default rates remain manageable. Governments also have structural incentives to support rising home prices. Home ownership is politically popular. Existing homeowners, who vote at higher rates than renters, benefit from price appreciation. Property taxes are tied to assessed values. A significant portion of household wealth is stored in home equity. A major price correction would trigger financial instability, political backlash, and balance sheet damage across the economy. This creates a policy environment where affordability and price stability are in direct conflict. Making homes affordable for new buyers requires prices to fall or incomes to rise dramatically. But falling prices harm existing owners and destabilize the financial system. So policy tends to favor price support over affordability. Zoning and supply constraints are real, but they're also politically useful. They allow the conversation to focus on local land use decisions rather than the structural role of credit and monetary policy. Blaming zoning implies the problem is solvable through reform. Blaming credit conditions implies the problem is embedded in the financial system itself. Consider the mechanics of a typical purchase. A household earning $160,000 annually can afford a monthly payment of roughly $4,500 under conventional lending standards. At a 7% interest rate on a 30-year mortgage with 10% down, that payment supports a purchase price of around $500,000. If rates drop to 4%, the same payment supports a price of $650,000. The buyer's income hasn't changed. The house hasn't changed. But the price the market will bear has increased by $150,000, purely due to financing conditions. This dynamic explains why housing prices rose so aggressively during the low-rate environment of the 2000s. It wasn't just supply shortages. It was that buyers could afford to pay more because borrowing was cheap. Sellers, seeing higher offers, raised prices. Appraisers, using comparable sales, validated those prices. Lenders, seeing rising collateral values, extended more credit. The cycle reinforced itself. When rates rise, the cycle should reverse. But it doesn't, at least not quickly. Existing homeowners locked in low rates have no incentive to sell. New buyers face higher rates but can't force sellers to lower prices. Inventory tightens. Prices stay elevated even as affordability collapses. The system isn't designed to produce affordable housing. It's designed to produce maximum loan volume within acceptable risk parameters. Affordability is a byproduct, not an objective. Outcome divergence. Consider two households, both earning $160,000 annually, both looking to buy a home in the same market. Household A purchased in 2019. Interest rates were around 3.5%. They bought a home for $420,000 with 10% down. Their monthly payment, including taxes and insurance, is roughly $2,800. That represents about 21% of their gross income. They have margin in their budget. They can save, invest, handle unexpected expenses. The home has appreciated to $520,000. They've built equity. Their financial position is stable. Household B is purchasing in 2026. Interest rates are around 6.5%. They're buying a comparable home, now listed at $500,000. With 10% down, their monthly payment is approximately $4,200. That represents 31.5% of their gross income. They have less margin. Savings are slower. Unexpected expenses are more disruptive. They're paying more for the same house with less financial flexibility, despite having the same income. The difference isn't effort, planning, or financial literacy. It's timing and the structural conditions that existed when each household entered the market. Household A benefits from a locked-in low rate and price appreciation. Household B is penalized by higher rates and elevated prices. Both are making rational decisions within the system, but the system produces dramatically different outcomes based on when you engage with it. This divergence extends beyond individual purchases. Entire generational cohorts experience different housing affordability conditions. Those who bought in the 1990s or early 2000s entered markets where home prices were 3 to 4 times median income. Those entering today face ratios of 6 to 7 times median income in many markets. The structural advantage isn't just lower prices. It's the compounding effect of lower debt service, greater savings capacity, and equity accumulation that can be leveraged for future investments or passed to the next generation. The system rewards those who already own and penalizes those trying to enter. That's not a moral judgment. It's a description of how the incentives are structured. Why this pattern persists. The misalignment between housing prices and incomes persists because the system is designed to prevent correction, not enable it. Psychologically, homeowners view their property as wealth. A price decline feels like a loss, even if they have no intention of selling. Politicians understand this. Policy is crafted to avoid triggering that perceived loss. Institutionally, The financial system is deeply interconnected with housing. Banks hold mortgages. Pension funds hold mortgage-backed securities. Households hold equity. A significant price correction would cascade through the economy in ways that are politically and financially unacceptable. Informationally, the narrative around housing is shaped by those who benefit from rising prices. Real estate agents, lenders, developers, and existing homeowners all have incentives to promote homeownership and price stability. The message is consistent. Buy now. Prices always go up. Renting is wasting money. That message isn't necessarily false in aggregate over long time horizons, but it obscures the structural reality that affordability has deteriorated and that many buyers are taking on levels of debt that leave them financially fragile. The persistence of high prices also reflects the fact that housing is a positional good. People don't just want a place to live. They want a place in a specific location with specific characteristics. Supply can increase, but desirable locations are finite. As long as credit is available, prices in those locations will reflect what buyers can borrow, not what construction costs. The system doesn't correct, because correction is structurally resisted at every level. Rational interpretation. Understanding this system doesn't provide a solution. It provides clarity. Housing prices are not primarily a function of supply and demand in the traditional sense. They're a function of credit availability, interest rates, and policy decisions that prioritize financial stability over affordability. The price-to-income divergence isn't a temporary distortion waiting to correct. It's the result of decades of policy choices, financial innovation, and structural incentives that favor asset price support. Recognizing this allows for a more accurate assessment of what homeownership actually requires. It's not about budgeting better or working harder. It's about having the income level, timing, and financial position that align with the structural conditions of the market. It also clarifies why common solutions, building more housing, reforming zoning, are necessary but insufficient. They address supply without addressing the credit and policy dynamics that set prices. The system operates according to its incentives. Those incentives are not aligned with making housing affordable for median-income households. That's not a conspiracy. It's just how the structure works. Closing reflection, plus soft CTA. The gap between housing prices and incomes isn't an accident. It's the predictable outcome of a system designed to maximize credit extension and protect asset values. Understanding that system doesn't change it, but it does change how you interpret the signals the market sends and the narratives that surround it. If this kind of structural analysis is useful to you, consider subscribing. We'll keep breaking down how these systems actually operate.